So we've just had some changes to the way ISAs are going to work from next year in the autumn statement. Originally, I wasn't going to make a video about this as I didn't think the changes were worth mentioning. But I've noticed there's been a load of videos pop up and I don't actually agree with what they're saying. So I thought I would share my brutally honest view on what's been announced. Well, I say announced, it was actually hidden inside this beautifully designed document all the way down on page 90. Under this section called Personal Tax and Savings. There's 10 changes altogether, some I think are positive and some not so positive. So let's go through them and I'll give you my take. First is this one, which people are most excited about. 5.38, allowing multiple ISA subscriptions. The government will allow multiple subscriptions to ISAs of the same type every year from April 2024. Now I get why this one could be really positive. I've had a lot of people coming up to me who have opened an ISA without realising they can't open one on a different platform. I spend a lot of time explaining you can only open one per tax year, so it will solve that problem. And on the surface, for some people, I think that's really positive. But my question is, do you really need more than one ISA each tax year? I get that some people do want more than one, but this is a huge issue with ISAs and something that is on the plate to be reformed. For example, right now you can have a junior ISA, a lifetime ISA, a stocks and shares ISA, a cash ISA, a flexible ISA, a general investment account, and a SIP or a self-invested personal pension, and an innovative finance ISA. Not to mention things you can have like investment trusts, but let's not get onto those. That is 8 accounts. So I have people who approach me and say, hey Chris, I have a junior ISA, should I be transferring this into a stocks and shares ISA or a cash ISA or just a general investment account? Or should I be putting it into a lifetime ISA or putting it into a SIP? What the change is now going to add to that mix is, oh, by the way, I've also opened 4 ISAs this year. I've got one on Invest Engine where I have 7 different funds, a trading 2-on-2 ISA with stocks and funds. I've got an ISA on Interactive Brokers and one on Moneybox in Balanced Funds, with no real idea on why they've opened 4 and what they've bought, just trying them all out to see what's best. And while I get that can be really fun, it also wastes time by not coming up with a proper investment strategy. If someone asks me how to invest, my answer should be much easier. It's already extremely hard, and the argument is that is giving people the ability to have multiple accounts all over the place really beneficial? Remember, at the point you're at now, you possibly know enough to be able to run 2 ISAs, or at least feel confident enough to do it. For a beginner, most people struggle to understand the difference between a cash ISA and a stocks and shares ISA. Really, we need the whole process to be much simpler. And the reality is, if someone asks my advice about which ISA to open, in my opinion, it's pretty simple. ETFs, Invest Engine, cheapest option. Stocks and ETFs, trading 2-on-2. Again, it's just the cheapest option. And before you open any, try it out with a regular account first. Simple. But as much as I think the process should be simplified, there's a bigger problem. Hopefully you will have been lucky enough not to have experienced this problem, but who is going to track all of the contributions? At the moment, you can actually have multiple ISAs open from different tax years and overpay your allowance. Let's say out of your 20,000 last year, you paid in 16k within the tax year, and this year you've managed to fill 20,000 in your new ISA. But you think, hey, I've got 4,000 left from last year, I could use that. You fill that, and then you've overspilled your ISA allowance by £4,000. This is where you can incur a penalty charge and have to pay tax on the excess and speak to HMRC. I've had about 10 or 20 instances of this happening where people have overpaid in the last 3 years, so it's not super common, but it does happen. The question is though, if this is now a thing and more ISAs are being opened, is this something that is going to increase more and more? Unless somehow the tracking system is improved. This part here may be key. 5.44, digitalise the ISA reporting system. The government is announcing the digitalisation of the ISA reporting system to enable the development of digital tools to support investors. It would be amazing to have one central location to track all of these limits. Unfortunately, I can imagine this being through the government website, and I'm not sure about you, but between all of my different portals for my business, VAT, tax and personal, every time I go on there and I have to do something, I am banging my head on the desk. Fingers crossed it will be good, but if it's anything like the Track and Trace app, I won't hold my breath. But first, I want to say a huge thank you to Webull for sponsoring today's video. Webull is a really smart new investing app that could change the game. Webull supports real-time quotes to help investors better understand the market supply and demand. All new users get access to 1 month of level 2 quotes from the Nasdaq Total View for free, providing the most comprehensive market information that you could ask for. If you've been feeling like other apps are lacking features you may want, this could be the app for you. You can trade up to 16 hours in the US market, including pre-market and after-hours trading. Webull provides a feature to place orders directly from the chart, and a range of different ways to purchase that you won't find on other platforms. You've got things such as limit orders to buy at a fixed price, and you can set it to automatically buy if the price continues to fall, or if the price rises, so you can really take advantage of movements in the chart. Speaking of charting, their charting tools are really user-friendly. They've over 50 technical indicators and 17 drawing tools, so if you fancy yourself an advanced trader, it allows you to quickly do things like add a moving average. But more impressively, Webull also has a really powerful stock screener tool to help you find the perfect stock. Here you can see ratings that analysts have given to the stock and company financials, doing a lot of the hard work for you. You can join Webull now and get 90 days commission-free trading for the US market and receive a complimentary 1-month subscription to Level 2 Advanced Nasdaq Total View from the day you sign up. It's free for a month and charges do apply. I'll leave a link down below for anyone who wants to check that out. Next is this one, 5.39, allowing partial transfers between providers. The government will allow partial transfers of ISA funds in year between providers from April 2024. This is much more modern and should be allowed. But my concern with this is how long will it take? Transferring an ISA can be painfully slow as it is. Will partial transfers improve the process or make it much slower? Coupled with the fact a single person could be transferring 5 ISAs if opened within one tax year, could the system grind to a halt? We'll have to wait and see how good their digitalization is, but I still think it's good you can partially choose to transfer your ISA if you need to. The thing to consider here though, of course, is that a lot of providers, because of how their systems work and how their low-cost methods use money to pool funds together to buy index funds in a low-cost way, a lot don't allow you to do in-situ transfers, meaning you'll need to sell your assets and move it anyway. But still, maybe you can bring across the cash part, which would be beneficial. This one, 5.4, removing the requirement to reapply for existing ISA annually, is honestly neither here nor there. You have to click a tick box, which literally takes about 5 seconds. Nice to see they are removing it though. I suppose at the moment it's good to actually have a reminder about the fact you're opening an ISA, since you can only open one per tax year. These two essentially expanding innovative finance ISAs to include long-term asset funds and open-ended property funds. I bet half of you probably saw that and haven't even heard of an innovative finance ISA. They are the least popular type of ISA, and I'm glad you haven't heard of them honestly. They're centered around peer-to-peer lending, which in my opinion is pretty risky. The two types of funds they're adding to them I also think are much higher risk than what I would recommend to somebody. If anyone's made good money from these, I would be interested to hear your views in the comments, but it's certainly not something I would recommend. I mean, why bother going for high risk when you can go for a low-cost index tracker? This one's probably more of a technicality that people want to be able to hold these assets within an ISA if they wish to, but I'd just get rid of this type of ISA honestly. Put it into some other kind of investment device away from the general public. I think the perception of an ISA is generally safe, although we know it can be unsafe, of course. Any investment carries risks, but we don't need higher risk investments tarnishing the reputation. This next one is the one that scares me more than any other, and I'm surprised how many people feel positive about it. 5.43. The government intends to permit certain fractional shares contracts as eligible ISA investments. I've seen people almost jumping for joy that this means it's confirmation people's fears about fractional shares not being able to be held within an ISA are over. This just means you don't need to hold an entire stock, just a fraction of it. You could still own one stock outright though. It'd just be hard work, as people being able to buy say £10 of stock has made investing much more accessible, since you can invest in smaller amounts. So what's wrong with it? Well, notice this word, certain. This is a sneaky word, and I don't like it when they use sneaky words. Certain in particular is something we think of as being a certainty, like something is certain to happen. But when we look at the definition it uses as a pronoun, it's some, but not all. So what does certain mean? What I worry it could mean is only a select range of stocks will be able to be held fractionally within an ISA. And what is the government's main objective right now? To stimulate growth within the UK. So what if certain actually means just UK stocks? Just throwing it out there. Why not just say fractional shares will remain untouched or be able to be held within an ISA? Why have they thrown this sneaky word in? It does worry me. Why do they want to touch fractional shares? If they do, it will definitely be a step backwards to getting more people to invest. I mean, the underlying question is, do the government really want everyone investing in accounts that can't be taxed? Maybe the aim is to get more money in general accounts so they have to pay HMRC. And it won't really affect people with larger portfolios, they'll just buy whole stocks, although it will be frustrating. It will mostly affect people who can't afford to own entire stocks. Then was this 5.45, harmonise ISAs to those over 18 years of age. This one's fairly decent, although I do think you should have the opportunity to put money in an ISA from the time you start working. At least the lifetime ISA now, with house prices being so expensive. I would like to see that lowered alongside a full education scheme for schools to teach it. Next is this one, 5.46. The government is essentially freezing the limits for accounts in the next tax year. They've essentially just decided to leave the limits the same as they are for now. I think this is fine, as most people can't afford to max ISAs anyway. Even if they did, it's most likely they wouldn't be able to max a SIPP too, unless they are really fortunate. Especially with the way cost of living is now. Between the two, you can invest £52,000 per year of your own money into them. Even more this year while the SIPP limit is £60,000. I don't think you should be investing any more than that unless you're really desperate or have a need to. Really, go enjoy your life. There is also an argument that this creates a sort of stealth tax. As wages rise, then so should the saving vehicles. So essentially, the excess is forced into taxable accounts. I have a feeling this will change in the future though. But also with the cost of living, I'm pretty sure any excess people are earning by rises in wages is being eaten up by the cost of everything, rather than having extra money to invest. And the last one, which I think is quite controversial, is this one, which I saw coming. 5.47. They are removing the lifetime allowance. This one, I think, is a definition of a first world problem. Oh no, I've got £1 million in my pension, help! What a problem to have, eh? I mean, personally, I think you've worked so hard all your life, pay tax up to your eyeballs, anything you buy with your money will be taxed, then they'll still tax you when you withdraw it, and then they'll tax it when you die. So really, I think it should be lifted to an extent. I mean, when you think it was 1.5 million in 2006, 1.8 in 2011, it does seem odd that it's lower today than it was 18 years ago. I mean, it's obviously to get more people paying tax, but what this has created is a problem where people work out their investment pots and go, there's no point in me continuing to work. In particular, this has happened a lot to doctors, who paid a lot into their pensions to reduce their tax. They're close to the lifetime allowance, and then they realise there's no point working as it's not beneficial enough. Not really a problem we need in this country. I mean, they can already pretty much double their salaries going abroad as it is. But I definitely see on the surface of it why people want it taxed. I'll probably hit it if I keep saving the way I am, so at some point it may stop me investing depending on my projections, but we'll see. But the truth is, it doesn't really matter which way you fall on this because Labour don't like it. So when they get in, they'll reverse it anyway, so I wouldn't really worry about that one. It's likely to just keep coming and going through the remainder of our lifetime. I think the biggest points to take from this are partial transfers should be good, multiple accounts I'm hoping will do more good than harm, and fractional shares, geez, we'll have to just see. I certainly can't bet on that one. Let me know what you guys think of all of these. Will you be opening multiple ISAs? I think I'll be sticking with just one. I hope this was useful. I do think sharing a different perspective is always interesting, and I'll catch you in the next video.